financed LIV league. It comes after weeks of speculation that Smith was defecting from the PGA Tour. The Telegraph reported earlier this month that the deal was worth more than $100 million. In a magazine interview, Smith said money was, quote, definitely a factor in his decision. That's your Bloomberg Business Flash. Tom?
OK, Alice, thank you. Coming up, returning to Wall Street, two big investment banks remove some of their last remaining COVID-19 protocols, paving the way for a return to the office 5 days a week. More on that next. This is Bloomberg.
SCG ล็อกสีสวยทนจากทุกสภาพแวดล้อมที่มีเทคโนโลยี Color Lock Plus.
We believe in the power of ideas. That's why we launched Bloomberg New Economy Catalyst. This platform will help them share their ideas to reshape our world. Bold thinking, breakthrough action. Bloomberg New Economy Catalyst.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our targets.
Spare capacity is becoming scarce. We are running on thin ice.
No one deliberately wants to go into battle, but we sleepwalk into conflict.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
Welcome back to the Open. 23 minutes into the European trading day. You're looking at gains of 0.3% across the benchmark European stocks 600 futures. Nasdaq futures up by 0.6%. Work from home, that big question around the readjustment. Goldman Sachs is lifting some of its final COVID rules, including vaccination requirements. The New York Times says it is seen or has seen a memo ordering staff back to the office 5 days a week. What a shocker. Morgan Stanley is also easing some of its COVID mitigation efforts. For more on this, I'm joined by Bloomberg's Benedikt Kamel in Berlin. Benedikt, good morning. What are the rules then that Goldman and Morgan Stanley are easing?
So this is principally around the idea of access to the offices. Morgan Stanley has said that testing requirements will no longer be enforced. Goldman Sachs is doing something similar. They're saying that vaccination status is no longer a key necessity, getting access to the office when you're coming into New York from outside. So it basically makes it easier for people to come into the offices. And this is sort of part of the push, particularly by Wall Street, but really the larger economy, the office-based economy, to get people back to the office more than just 1 or 2 days a week or even less. We still have very underpopulated offices, office spaces in places like New York, like the City of London, Frankfurt, Paris. A lot of people over the last 2 years have gotten sort of used to doing at least sort of the bookends of the week, the Mondays and Fridays at home, maybe even more than that. It's almost a generational thing. Younger people have sort of started enjoying the fruits of working from home, and it's the older people, the executives, who are saying, really, you should come back to the office more, and this is part of this.
Yeah, that generational divide is going to be a shock to the system for some, isn't it? 5 days a week. Goldman Sachs were kind of really out front on this early on in the pandemic and kind of pushing staff back into the office. Why have banks in particular been so keen to get their staff back in?
They really say it's part of our culture, it's part of our DNA, it's how we do business. You can't really do what we do from home. You can do it for a while if you have to, but once these hurdles are removed, as they now have been, there's really no reason to stay at home. They also say it's a way for younger people starting out in a Wall Street career and a finance career to get ahead, to meet older people, to meet more senior people, to get noticed essentially, and that's, again, the sort of thing you can't do from home. David Solomon, the Goldman CEO, said famously last year that working from home is an aberration. We had the Morgan Stanley CEO bemoaning that people felt fine going to the restaurant but not coming into the office, so he felt there was a bit of a sort of a double standard going on there. But again, younger people have learned to live with working from home at least some part of the week, and turning that back is going to be very difficult.
Yeah, is there a risk on that point then, Benny? Is there a risk in terms of staff retention and attracting talent?
Absolutely. I mean, work from home has become an important metric for a lot of people. They look at what kind of flexibility an employer might offer. And if you're a hard-nosed bank or another institution saying, sorry guys, you need to come in 5 days a week or you won't come in at all, then some people might look elsewhere and might think about, is this really the kind of life I want to lead? This is 2.5 years. A lot of people have become accustomed to this kind of work from home, work in the office kind of mix. And so younger people in particular, and that's often where the talent war is, they might think, well, this is not really how I'm planning my future. I'd like to go somewhere where I have more flexibility built in. So really, it's a bit of a balancing act for a lot of banks between sort of retaining their DNA, retaining their culture, but also giving people some flexibility.
Benny Camel in Berlin, shirking the sunshine to be uber productive in our offices. Thank you very much indeed. Coming up, we will be talking to the Klarna CEO as the buy now, pay later company reports earnings. That interview is next. Stay with us. This is Bloomberg.
ไม้สังเคราะห์ SCG ล็อกสีสวยทนจากทุกสภาพแวดล้อมที่มีเทคโนโลยี Color Lock Plus
At Bloomberg, we believe in the power of ideas. That's why we launched Bloomberg New Economy Catalyst. It's a community of global leaders and innovators who are blazing new trails to transform business and government. This platform will help them share their ideas with the world and provide access to the resources they need to bring them to life. Bold thinking, breakthrough action. Bloomberg New Economy Catalyst.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy, I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
Is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
Welcome back to the Open. We are 30 minutes into your European trading day, and here are your top stories. Turning off the taps, the Nord Stream pipeline begins a planned 3-day shutdown while Gazprom halts deliveries to France's Engie. Jobs jolts, US labour data and a key consumer confidence gauge signal stronger demand, paving the way for larger Fed hikes. Plus, back to work. Goldman Sachs and Morgan Stanley call in their employees, dropping COVID rules as Wall Street looks to get back to the office. Let's check in on these markets then. We talked about that improved survey around consumer sentiment in the US. The jobs market, again, looking very tight. More than 11 million positions unfilled in the US. And that, again, underscoring the view that the Fed is going to have to continue to act aggressively in terms of rate hikes. And certainly officials reiterating that message we got from Jay Powell over in Wyoming on Friday. 2 officials overnight saying that, yes, higher for longer is the trajectory for rates out of the US. The European markets currently just range bound after being in slightly more positive territory. You saw gains of around 0.2%. That's come off. So very much uncertain in terms of the direction for these markets this Wednesday here in Europe. The DAX over in Germany down a 0.1% here in the UK. FTSE 100 down by 0.2 or 11 points. Let's move it on to see how things are playing out across your sectors. Technology was top of the list the last time I looked. It remains there, up 1.7%, despite the likes of HP overnight downgrading its forecasts on softer demand for things like PCs. Auto's also doing pretty well this morning, up more than 1%. And some of the safe havens in terms of healthcare utilities leading the losses, down between 0.5 and 0.8%. But there's really a lack of catalyst, a lack of direction for these markets, at least midweek here in Europe. Let's get more in terms of the first word news with Alice Atkins. Alice.
Hi, Tom. The last leader of the Soviet Union, Mikhail Gorbachev, has died at the age of 91. Russian news agency says he passed away in a Moscow hospital after a long illness. Gorbachev pushed for radical change to the Soviet economy after becoming Communist Party leader in 1985. His overhaul unleashed a political avalanche that brought down the Berlin Wall in 1989 and ended Soviet rule 2 years later. Pakistan and the UN have launched an appeal for $160 million in emergency funding after unprecedented floods caused by weeks of monsoon rain. The government says more than 1,000 people have been killed and nearly 500,000 forced into relief camps. Pakistan's foreign minister says shelter, tents and mosquito nets are needed urgently. US life expectancy fell by almost a year in 2021, making the biggest 2-year decline in almost a century as the COVID-19 pandemic ravaged the country. According to provisional government data, life expectancy at birth dropped to 76.1 years, the lowest level since 1996. And 2 of Wall Street's biggest investment banks are removing some of the final hurdles to fully returning to offices following the pandemic. Goldman will let employees outside New York enter offices regardless of vaccination status with no regular testing requirements. And Morgan Stanley is also easing some of its COVID mitigation efforts. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom?
Alice Atkins here in London, thank you. OK, Swiss global private markets investment management firm Partners Group has posted a first-half profit beat. This despite an expected sharp drop in performance fees. The company says management fee growth has been driven by robust client demand. Joining us now is David Layton, CEO of Partners Group, joining us in the studio. David, thank you very much for coming in. Congratulations on the results. Walking us through what some of the key takeaways were for you, what you're seeing in terms of that client demand in this environment of higher rates, recession fears, of course, and very high inflation.
Yeah, what we're seeing is a sustained interest in private markets is an increasingly important part of client portfolios. We raised about $13.1 billion of new capital in the first half of this year and increased our management fees from managing those assets by about 18%. Which I think demonstrates this sustained demand that people have for private markets, even in an environment like this where we see volatility. I think one of the benefits of private markets is that we have a very long-term view on the investments that we make. And I think in this current environment where there's so much short-termism, that appeals to a certain percentage of the clients. Do you see
that kind of fundraising that you had in the first part of this year? Can that be sustained, that level of demand, that level of activity from your clients?
I think it can be. Yeah. In fact, we have reaffirmed our full year guidance for this year of raising between 22 and 26 billion for the full year 22, and that is unchanged despite all of the ups and downs and negative data points that we've had throughout the course of this year.
There, of course, has been a significant adjustment in valuations in the public markets. Talk to us about the adjustment in valuations in the private markets and how much further there is to go in that process, if at all.
Yeah, it's a great question. So between 2018 and 2021, the public markets had multiple expansion from about 12 times earnings to about 18 times earnings, and we've seen a correction down to about 13 times. Over that same time period within the private markets, we saw an earnings multiple expansion from about 11 times to about 12 times on average, so dramatically less than what was seen in the public markets. Now, there are certain pockets within private markets, technology investments, for example, where the valuations got very, very frothy. But on the whole, it was much less heated than it was in the public markets. Now, will that correction come down to 10.5 times or 11 times? Yeah, I think it will. And I think buyers and sellers are in the process right now of going back and forth on where they think value should settle.
So what is looking most attractive at this point across the space that you look at, and how are you able to, is it becoming more challenging to generate those returns that your clients expect in this environment?
It is definitely becoming more challenging to generate those returns because for a long time we had cheap financing that could help to facilitate that. And so the private markets industry is becoming much less about buying and selling and leveraging and much more about rolling up our sleeves and fundamentally impacting the businesses that we're investing into. And so we have two strategies to help us to continue to consistently generate those high returns. The first is a thematic approach to investing. And we're finding little pockets of the economy, little subsectors that have some structural tailwinds behind it, and that's where we're dedicating all of our effort. We don't want to serve just anything that eat just anything the market is serving up at the moment. We want to be very specific, the types of assets that we're going after. And the second is what we call our transformational investing strategies. And so when we take ownership for a company, we are driving strategies that are much more comprehensive than we might have needed to in years past, because you just have to work harder in an environment like this to generate the same types of returns that our clients have become accustomed to.
So you talk about rolling up your sleeves. As you look across the portfolio of companies that you've invested in or that you own outright, how much pressure are those companies, how much pressure are on those companies at the moment as a result of this environment they're in? And are they looking at job cuts, cost cutting? What are you seeing in terms of your portfolio companies, the pressure that they're under?
Yeah, so we have several dozen companies that we have stewardship for. On average, they experience EBITDA growth of about 15% over the last year. And so that's pretty good performance for a portfolio that's having to navigate through all of the challenges that we're seeing. Inflation is certainly a topic. In the first quarter of this year, we had price increases that we were passing through, didn't feel much pushback. In the second quarter, price increases we were pushing back without a lot of pushback. What's interesting is that now as we enter the third quarter, people are really starting to bite back on price increases. And so we're all talking about inflation and what are we seeing? We get pretty good insight.
There's a squeeze on margins then.
There's the potential to be squeezed on margins, so we're going back and we're squeezing our suppliers as well. We've actually been able to maintain the exact same margin over this last calendar year, and we reported that to the public yesterday in our results, we had, if you aggregate all of our positions together, about a 20% margin last year, and we had about a 20% margin this year. So we've been able to maintain those EBITDA margins, but it has been a fight.
Do you see that holding up in 2023, that 20% margin?
We do see that holding up, and it's going to be work, and it's going to be a lot of effort, but we do see that holding up.
Just before we let you go, the role of private debt markets in terms of driving activity, public versus private, and that transition. Is this a pivotal moment that we're seeing? What is the longer-term trajectory when it comes to these catalysts?
Well, one of the things that we're seeing is that the private equity industry, which has been facilitated by the private debt markets, et cetera, is increasingly becoming a traditional asset class. For a long time, if you were an investor that wanted to get exposure to bedrock companies, you had to go to the public markets. And the private markets was where you went to get exposure to risky venture capital investments and the like. But today, increasingly, investors are turning to the private markets to get exposure to interesting assets that they wouldn't otherwise be able to access in the public markets. And
is that a search for alpha? Is it because the regulatory environment has become more conducive? What is that?
It's a combination of all of those things. You have companies that in a prior decade would absolutely be public companies that are choosing to stay private to avoid the complexity of the regulatory environment. And private markets firms have developed the capital base to be able to support those companies. We today are a $10 trillion industry and have the ability to support companies of a much larger size that, again, in a prior era would have been public companies.
Really fascinating insights into the world of private equity. Thank you very much for coming into the studio, walking through your results as well, and the view that you're going to hold up those margins across portfolio businesses around 20% in 2023, which would be quite the achievement given the economic conditions we are facing here. David Layton, CEO of Partners Group, thank you. Coming up, buy now, pay later, pain. As Klarna's losses deepen, we will speak to the CEO. That is next. This is Bloomberg.
SCG ล็อกสีสวยทนจากทุกสภาพแวดล้อมที่มีเทคโนโลยี Color Lock Plus.
At Bloomberg, we believe in the power of ideas. That's why we launched Bloomberg New Economy Catalyst. It's a community of global leaders and innovators who are blazing new trails to transform business and government. This platform will help them share their ideas with the world and provide access to the resources they need to bring them to life. Bold thinking, breakthrough action, Bloomberg New Economy Catalyst.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Strong enough to stay, we will never.
Welcome back to the Open. We are 43, almost 44 minutes into the European trading day. You're now seeing losses across the benchmark of 0.1%. Futures in the US still holding up, gains of between 0.2 and 0.3 on the Nasdaq futures. Now to a really, really interesting story, one that is consequential across the economy here in Europe, but also the US as well. It has a large footprint. Pay later, buy now, pay later firm Klarna's losses. They're deepening. Reporting first half earnings, the fintech company has posted a net loss of 6.2 billion Swedish krona. That compares to a loss of 1.4 billion krona in the same period last year. The company is contending with a worsening global macro environment and increased regulatory scrutiny to protect consumers. Joining us now is Sebastian Siemiatkowski, CEO of Klarna. Sebastian, thank you very much for joining us this morning. What really stood out for you from these results as we look ahead to the quarters ahead in as we said in the introduction, of course, a challenging environment?
Well, I think that, first and foremost, from our perspective, right? I mean, it always gets reported as this increase in losses, and we understand our perspective. But actually, the way we look at it internally, which I think is more relevant, is to look at what's the percentage loss as share of GMV, so the total volume that we process. And actually, even today, it's 0.7%, which we are quite proud of in tough times like this. Usually you see credit card companies at least 30-40% more than that. And I think it really speaks to the quality of our model. Now, in absolute terms, compared to last year, you will see quite significant growth, to your point, right? But that is a combination of our volume still growing at a very high rate. In addition to that, obviously, we also see a mix effect where our US business is becoming much larger compared to our European business, where our losses have been so extremely low over multiple years. So just on a mixed comparison level, the absolute numbers increases quite heavily. But again, we look at it as a in relationship to the total GMV, are quite proud to see the performance of our losses from that perspective.
And Sebastian, I know you've talked about your history of being profitable, and then, of course, you pursued that growth strategy, and part of that was the US element, of course, that growth in the US market. Now you're saying there is a need, and you're hearing this from investors, to go from that growth model to a model where you get back to profitability. What does that transition look like?
Well, I think, yeah, that's definitely the case. I mean, from my perspective, if we look at the long-term vision of Klarna, which is really to try to disrupt financial industries, and what, in my opinion, has been too high profits at the expense of consumers across the world, and we would really like to change that the retail banking industry from that perspective. And that is still as true as it was a few years ago. And what's attractive about it, obviously, is the addressable market here we're talking about is trillions of dollars, and it's a huge industry. So there's tons of potential. Now, what has happened in the investor sentiment is that maybe 6 months ago, people were willing to give us a little bit more credit and expectations that that is going to be happening, and we're willing to pay ahead of that curve. Nowadays, investors are a little bit more yeah, but there's some risk associated with those accomplishments and how fast will it happen and so forth. So there's obviously a higher level of being careful in assessing fintech in general. But to me, really, I mean, I look at the business, we're much bigger and much more successful than we were 6 months ago, and we're improving. So it's a shift in investor sentiment, but the consequence of that, obviously, is that we cannot afford being as forward-leaning, so we have had to reevaluate the size of our investments, and we've also had to reevaluate some of our investment strategies in regards to how many new customers do we bring on board versus how much do we focus on existing revenue per customer and improving the portfolio. So there's definitely a shift there, which unfortunately will not be visible in Q2 here, but will be visible as we start reporting. Q3 and Q4 will become more visible as well. There's always obviously a slight delay between the actions you take and the performance.
Okay, well, hopefully we can get you back on Q3, Q4 to talk through those changes as well and what materializes. Sebastian, in terms of buy now, pay later, of course, it's a big part of the business. You're under scrutiny for this part of the business as well. Talk to us about what you're seeing in terms of changing consumer habits. Are you seeing more people using BNPL for everyday items rather than the bigger ticket purchases?
Well, slightly, but again, it's never been a big ticket purchase in our regards. I mean, if you look at our average order value, it's about $100. If you look at the outstanding balances, we have $70 compared to a credit card of a few $1,000s. So, I mean, in the key aspect here that I think still is very relevant, and this is also something that comes across when we do speak and sit down with regulators and politicians, it's like everything else equal. If 10 years from now, less people have credit cards, more people have debit cards, but then occasionally use services as buy now, pay later to finance selected purchases, that is a better world. It's a better world because people would borrow less. The outstanding balances that our customers see is tremendously lower than the credit card balance. And if you use a credit card, you are borrowing against your groceries and everything you purchase. There's no selection at all, right? And then in addition to that, we don't charge interest, right? While a lot of credit cards in the UK may, for example, charge up to 50% or whatever. So there are a tremendous difference of cost in our products compared to the traditional products in this area.
And I know, of course, you're trying to build out additional services, or you are in the process of doing that beyond buy now, pay later as well. And that's a discussion that we can hopefully have at a future day, because we're running short of time. I know you've talked about, and you wrote about this and the distress for you and the other members of the team around cutting staff earlier in the year, around 10%. As you look at the administrative costs across the business, do you expect to have to lay off more people? Are there further strains on headcount that are coming through in the months or quarters ahead for Klarna?
No, because I think what we try to do, because I have the benefit of been doing this for 17 years. So I've seen a couple of financial cycles by now, and to us at least, we felt that we really aspired to make sure that it was a one big effort, that we could create certainty for all our employees and create a sense of, and I also think to some degree, I still hear a lot of startups out there, tech companies, that haven't yet come to the decision, haven't yet acted on this, even though there is a clear shift in investor sentiment that all companies in these sectors needs to take into consideration. And so I do think, and also a potentially worsening economy, obviously. So in our world, it was very, very important to rather make, not kind of do it in small portions or whatever, but make the big changes that we needed to do, and then kind of move on from there, even as much as it was very tough, obviously, to do them.
Okay, Sebastian, I have 101 additional questions, but we've run out of time, so we really hope to get you on again in the future. Thank you very much for your time. Of course, the CEO there, Sebastian Siemiatkowski of Klarna, one of the biggest fintech companies in Europe. Thank you. Coming up, Europe faces the risk of blackouts, rationing and a severe recession if Russia further slashes gas deliveries. We discuss the energy crisis next, the next chapter. This is Bloomberg.
วีลสุเครื่องครัวและเครื่องใช้บนโต๊ะอาหารราคาพิเศษช็อปเลย
At Bloomberg, we believe in the power of ideas. That's why we launched Bloomberg New Economy Catalyst. It's a community of global leaders and innovators who are blazing new trails to transform business and government. This platform will help them share their ideas with the world and provide access to the resources they need to bring them to life. Bold thinking, breakthrough action. Bloomberg New Economy Catalyst.
We are accelerating into a digitized and decentralized future.
That is why Bitcoin is here.
The cryptocurrency market has roughly a $3 trillion market cap. That's a huge milestone.
This is the largest, fastest wealth creation event in the history of the world. And financial institutions have only now just figured this out.
It is a power to the people kind of technology.
However, we are still tied to the centralized banking system in a way that is unnecessary.
The crypto sector today is largely unregulated.
This is a little bit like the American Wild West.
Essentially what DeFi is, it's like a big casino.
That's scary to the JP Morgans because they're seeing all this growth and they're left out.
You all can do whatever you want and I don't care.
We're seeing a revolution unfold right now. These are historic times.
Buckle your seatbelt. This is where the ride gets really interesting.
However you get your news.
Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Welcome back to the Open. 53 minutes into the European trading day. European stocks now turning low by 0.2%. Part of that will be linked, no doubt, to what's happening across the energy space. European governments are debating whether to intervene in energy markets and introduce an EU-wide price cap for gas and electricity. Brussels says the European Union's power price setting system is no longer functioning properly and needs reform, but the process of implementation has yet to be agreed.
We have been working on a price cap. You know that this is raising a lot of technical difficulties, so we are not opposed to the idea, but the concrete implementation and technical implementation of that idea seems to be quite difficult.
OK, the French finance minister speaking there. For more, we are joined by Bloomberg's power and gas team leader, Rachel Morrison. Rachel, what do we know about what is happening in terms of the plans from the EU and, of course, this Nord Stream 1 shutdown?
What we know is that Europe is drawing up plans, a sort of short-term emergency intervention to try to lower power prices, and then also a kind of longer-term reform of power pricing. So the main idea behind that is to try to split electricity from gas costs. So really trying to reduce the influence that the really high gas prices is having beyond just the gas market, so on electricity as well. And as France were mentioning just there, it's difficult because not every country has the same energy mix. They're not going to be impacted in the same way. And the problem with a cap is who pays for the money to cap it. So is it governments? How much would that cost? Where do they get it back from? So that's why also windfall taxes are being discussed at the same time. And these are huge changes that are trying to be hammered out very, very quickly to tackle this crisis as it gets worse. And as you mentioned, we have the flows on the Nord Stream pipeline, which brings Russian gas to Europe. They've halted for 3 days of maintenance. And really, there are huge fears in the market that those flows may not come back at all, or may come back at reduced levels, because they have been operating, that pipeline has been operating for quite a long time now at reduced levels. And we've seen this morning, late last night and into this morning, that Gazprom has cut gas to French utility Engie. So we're really seeing an escalating of what's happening in the gas market and a reduction in flows at quite a crucial moment for Europe.
Just a really great roundup of where we stand. Thank you. Bloomberg's Rachel Morrison, of course, leading our team on the gas question, and we continue to watch what happens there. The pricing now on Dutch gas currently up 10% as we watch what happens with Nord Stream 1. Markets lower by 0.2 here in Europe. Plenty more coming up. Surveillance Early Edition is next. This is Bloomberg.
บริการออกแบบและติดตั้งวิดีโอคอนเฟอเรนซ์โดยผู้เชี่ยวชาญ Smart Solution Computer.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
The difference between political gossip and policy intelligence. Bloomberg Government provides our clients with expert reporting, analysis, and public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
Everything you need to get set for the start of U.S. trading. Bloomberg the Open with Jonathan Farrow. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
We need to diversify away from Russian fossil fuels to reliable, like-minded sources.
There is a need to, as soon as possible, cut the link between the price of gas and the price of decarbonated energy.
We're committed to getting inflation under control, and there's a path to get there. A recession is obviously a risk.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. Turning off the taps, the Nord Stream pipeline begins a planned 3-day shutdown as Gazprom halts deliveries to France's Angie. Jobs jolt, U.S. labor data, and a key consumer confidence gauge signals stronger demand, paving the way for larger Fed hikes. Plus, back to work. Goldman Sachs, Morgan Stanley call in their employees dropping COVID rules as Wall Street looks to get back to the office. Well, it's a feeling of deja vu in these markets yet again. Future sessions starting higher, but unable to hold on to those gains as we get later into the trading day. It's been about an hour of cash equity trading. We're down about 1% on European stock 600. They've slid for now 4 consecutive gains if these losses hold up. We also had losses in the U.S. session yesterday of more than 1%. Strong JOLTS data, strong job data, and consumer confidence, all of that leading to this picture where the Fed can go at it harder, can possibly do 75 basis points. We are seeing a turnaround on the Wall Street future session up 0.2%. Euro, that's back up above parity. Some of the gains in the euro have been helped by higher stockpiles of energy. And falling nat gas prices, but that is turning around today. We are moving about 6.3% higher on Dutch front-month futures for gas. Now, looking at the overall picture for European equities, it is mixed, I suppose, if not negative. We are looking at UK stocks. Those are down 0.4%, perhaps leading the picture. Lower DAX equities, German equities, I should say, which were the only region to move higher yesterday, now is falling. So overall, it's just this drifting lower in equities with all of these concerns really gripping Europe and making it difficult to buy. Now, part of that is the 3-day halt of the Nord Stream pipeline. It's a key source of natural gas for Europe, of course, and it started today for maintenance works, that halt. That comes as the region's government scrambled to secure alternative energy supplies and fill storage facilities before winter.
At European level, we have agreed that all member states to do jointly save 15% of energy between August now and March 23. The second pillar is we need to diversify away from Russian fossil fuels to reliable, like-minded sources, mainly also to fill our storages. And here's good news. We have reached now an average in the European Union of storage filling of 80%.
We have been working on a price cap. You know that this is raising a lot of technical difficulties. So we are not opposed to the idea, but the concrete implementation and technical implementation of that ID seems to be quite difficult.
For more, let's get to Bloomberg's Berlin bureau chief, Birgit Jennen. So, Birgit, we have Europe discussing a lot of different models here to try to keep those energy prices under control. What is the position that Germany finds itself in this debate?
Yes, I mean, the German government, Habeck, who is basically looking at a mechanism which could work, echoed exactly what Le Maire just said, that really a price cap is extremely difficult to implement. It's not only costly, but it's really a massive market intervention, which at least the German government would like to avoid. They do want to limit the market effect. But obviously they are aware of the price fluctuations, which they would like to get under control. And therefore, they're looking at a mechanism which allows to tap the profits. How it is going to work has still probably to be looked at, and they will discuss this at the next Energy Council meeting. But they are looking at a kind of state power in order to a buying system, in order to basically take away profits and actually then pass it on to later on to the renewables.
We also have Nord Stream pausing, of course, for maintenance that was already planned. But the fear that arises from this, as it has in the past, that flows from Russia will stop through the rest of Europe. Do we have any more insight? Does Germany have any more insight into this maintenance work and whether it will result in reduced flows?
Well, this is exactly the problem that Germany has at the moment, not an open channel to Russia and even also to Gazprom. The talks are just seemingly non-existent, what we hear. So therefore, the German government is really at odds. What is going to happen? And that has been for a while now, and that is exactly creating the uncertainty Germany is under. It's even if Russia is going back afterwards, they do know to the 20% they have been delivering before the maintenance work. But the government knows that this uncertainty will prevail, and therefore they are looking for a solution to make the market more stable.
All right, Birgit, thank you very much for the update. Bloomberg's Birgit Jennen there. We're now joined by Klaus Bader, Global Chief Economist at Societe Generale. So, Klaus, I mean, look, a lot of uncertainty when it comes to the European energy story, especially when it comes to what sort of fiscal support we might get. Is there a scenario where fiscal support is enough to stave off the worst of the energy crisis, which we're expecting Europe to face?
I don't really think so. What I think is possible is to, find mechanisms in which to support those that are really hurt most. I would argue that middle and upper middle income households, upper income households, of course, don't really need necessarily the support here. I favor actually transfers to households. I think they're less complicated that really need it. It'll be difficult in the short term to really avoid something of a power crisis in Europe and in Germany in particular. In the short term, in the medium term, of course, Germany is building new facilities to import LNG, but in the near term, it's not easy. But there are a number of things that can be done. Germany is discussing keeping running its nuclear power plants a little bit longer than expected. Unfortunately, one of the consequences too that we're using a lot more coal and coal-powered energy, which of course is absolutely horrendous from a climate perspective.
I mean, I gotta wonder if there should be a discussion in terms of trying to curb households' usage of energy, whether that should be more prevalent, because, Klaus, I've heard people come on this program and say essentially that talking about price caps has this perverse effect of increasing demand for energy among households, which, of course, is not exactly what you want in this current environment.
Exactly, and that's my thinking when I'm saying I think it would be much better to just let the price set itself and support those with direct transfer payments who really need support rather than reducing the price. Because if you don't reduce the price, people are not going to save energy. But I think the story, I actually look at it with a certain amount of optimism, because the fact that Germany is as far advanced in the building of its reserves, and filling up its reserve capacity, I think shows clearly, despite the fact that the Nord Stream 1 has only been delivering gas at a rate of about 20% of what it did previously, clearly shows that consumer has reacted. And I think, there's lots of low-hanging fruits. We can turn off the streetlights after a certain hour, or maybe turn off only every other streetlight. In public sector, just a silly little story recently, I went to the office relatively late at 11 o'clock here at Canary Wharf in London, and there were 5 escalators running. At that time, 2 escalators do it perfectly. And so I think that there's lots of low-hanging fruit. I've seen it, in Asia and Japan and Korea, where they really are concerted efforts to reduce energy consumption. It is definitely possible without people freezing to death.
Yeah. I'll do you one better. Bloomberg in London. I don't even think we have any escalators here. But Klaus, okay, look. So at the time we're talking about an energy crisis in Europe and what can be done, over at the ECB, debates are unfolding about whether it's 50 or 75 basis points. I mean, does this conversation make sense? Does it make sense for the ECB to start moving into restrictive territory where at the same time we're talking about the possibility for blackouts in Europe?
Well, I think when you say blackouts, I think you're slightly jumping the gun on that. But yes, I think it absolutely does make sense to raise interest rates, because in the long term, very well which are the income groups that get hurt most by high inflation. It's the lowest income groups. And stabilizing inflation expectations, I think, is absolutely key, not just in the euro area, but in many other economies as well. Because what we are seeing is really, in Europe it took a bit longer, in the US we're well ahead, and in the UK also, you're seeing a very significant acceleration in wage pressures. That is going to increase cost pressures on company, and it's going to mean further price increases. So, I think, to me, it's very clear, and I've been arguing this for a long time, that monetary policy was just completely out of whack with the economic reality. And central banks have held on to this narrative of temporary inflation for way too long. They're behind the curve, and I think we need to get away from these levels of interest rates, which, don't forget, in real terms, interest rates are just dramatically negative. And I was just looking yesterday. I was looking yesterday at a couple of indicators of financial conditions from the Federal Reserve System member banks. And in the US, financial conditions are not tight. And I would argue that in Europe, financial conditions are also not particularly tight. The difficulty the ECB, of course, has is what is going to happen to peripheral spreads. And that's the big concern for them.
All right, Klaus, hold that thought. We're going to continue the conversation, especially when it comes to the Fed as well. I want to get more of your thoughts on that. Klaus Bader, global chief economist at SocGen, is going to stick around with us. Now, coming up, U.S. labor data and a key consumer confidence gauge indicate stronger demand, paving the way for potentially bigger Fed hikes. At least that's what the market has started to price in. We'll discuss that next. This is Bloomberg.
SCG ล็อกสีสวยทนจากทุกสภาพแวดล้อมที่มีเทคโนโลยี Color Lock Plus.
We believe in the power of ideas. That's why we launched Bloomberg New Economy Catalyst. This platform will help them share their ideas to reshape our world. Bold thinking, breakthrough action. Bloomberg New Economy Catalyst.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
The top names at the Fed are on Bloomberg.
I have a baseline case going into September that is 50 basis points. That's where I've been since the last meeting. But I have an open mind about whether 75 is going to be necessary. 50, 75 doesn't just depend on a data point, even an important one like the CPI. I like to say that we're data dependent, we're not data point dependent.
Nobody covers the Fed like Bloomberg, your global business authority.
You've likely seen that over the last 4 meetings, we've raised rates 225 basis points. We've started shrinking our balance sheet, and we've signaled there are more rate increases to come. We're committed to returning inflation to our 2% target, and we'll do what it takes to get there. The pace of when we get back to our target, which is 2%, is uncertain. But as a result, our commitment to bring inflation down, which hopefully you welcome, leads to worries about a recession. And I understand why.
Richmond Fed President Thomas Barkin there speaking in West Virginia. Some lines crossing. Italy's preliminary August CPI rising more than expected, coming in at 9% year over year. The estimate had been 8.2. Of course, CPI numbers coming in fast and thick this week. We had Germany yesterday about 8.8%. Well, let's get back to the U.S. story. Still with us is Klaus Bader, global chief economist at Societe Generale. So, Klaus, I look at some of the U.S. data yesterday. You had JOLTS numbers. Those indicating yet again a very tight labor market. Consumer confidence also surprising to the upside. How are you interpreting this incoming data at a time where it feels like it's just a world bracing for an impending recession?
Well, I think that first of all, it suggests that there isn't an impending recession, maybe in a couple of countries. In the UK, I think probably recession has already started. And in Germany, it's pretty likely that we're going to get a shallow recession. But in the euro area, actually, we don't expect a recession. As far as the US is concerned, we don't expect recession to materialize before, maybe early 2024, but it's not imminent. Now, I thought that the data yesterday was very interesting. I don't care much for consumer confidence, and I think consumer confidence usually gives a terrible guide to consumer expenditure. In fact, at the current junction, it seems to me that all those recessions, that people are so worried about a recession that they're resorting to retail therapy. The U.S. consumer spending has continued to be very strong. But yes, I found the numbers yesterday, the JOLTS numbers, very interesting. They first of all revised up the previous month, then it showed a gain in open positions. And one of the metrics that I like to look at is what they call in Japan the job to applicant ratio. And in the US, that had peaked at 1.99, it slipped to like 1.88. And yesterday's numbers, courtesy of that increase in job vacancies, and of course, a very significant reduction in the number of unemployed in the last monthly report, this ratio has once again increased to basically match its peak. And the other thing that I saw, the labor market is still incredibly strong. And secondly, what I found really interesting is that in the latest national accounts data, the U.S. corporate profit margin, that's on a so-called NEPA national accounts basis, actually increased. And when you look at the price pressures on companies, both from upstream price pressures as well as from labor costs, that's really not what you'd expect. We think that the corporate profit margin is a really important driver of recessions. And that increase in that profit margin has, in our view, moved out the recession even further into the future.
Let me play devil's advocate, though, because Mike Wilson over at Morgan Stanley has pointed to the fact that he thinks that corporate margins are going to start to come under pressure given inflation, given continued supply chain weakness, and that the last earnings season we got, it basically was just pushing out the pain. So are you essentially saying that you don't see that deterioration in corporate margins?
I do see that deterioration. Absolutely, I see that deterioration. That's what I'm saying. We could be there in 2024, but what I'm saying is that this, and you have to differentiate between companies' profit reports and the corporate profit margin in the national accounts. They're slightly different beasts. But what what this surprise increase suggested to me that actually the recession is further out into the future than I thought previously.
Interesting. I mean, what does that mean?
Profit margins are going to come under pressure. I think that's inevitable. But profit margins are at a very, very high level. They're way above the long-run average.
So, Klaus, we get a recession further out. This is fascinating because we currently have a market right now that's pricing in Fed cuts September 2023. That's been pushed out, of course. But are you saying that the market also needs to readjust its pricing as well? That perhaps any potential Fed slowdown won't occur till the time you're talking about, when we perhaps get a recession further down the line?
Yeah, absolutely. Markets have been incredibly aggressive about pricing in Fed cuts. I think that's very premature. I think it's going to take significantly longer. We're seeing that the Fed has to work hard to slow down the labor market. And, there's one thing too that I've been, that wave, I've been riding that now for quite a while. For me, they're what I call excess savings. Now, I want to say that what I mean with excess is over the pre-existing trend. And actually, in most economies, most advanced economies, that building up of excess household savings has continued. The U.S. consumers have been the only ones who've kind of dipped into this, meaning that the household savings rate has dropped below the pre-crisis level. They're not actually dissaving, but they're saving less than before the crisis. But and they're supporting consumption. But the degree to which they are dipping into those savings is very, very small and very stable. Interestingly, in fact, in 7 months of the saving, U.S. households have used up, according to my calculations, about 6% of the 2.56 trillion that they had at the beginning. And that number, by the way, is
so definitely not.
Share.
So definitely not through the savings. Klaus, I'm sorry, I'm afraid we're going to have to end things there, just up out of time. Thanks so much for joining us, though. Klaus Baader, Global Chief Economist at SocGen. Now, coming up, China's factory output contracts for a second month. We'll discuss the state of Asia's largest economy next. This is Bloomberg.
อร่อยเข้มข้นได้ประโยชน์เน้นๆผลิตภัณฑ์นมข้นหวานตรามะลิโอวัลตินอิสตี้สควีซ
เซรั่มช่วยลดเลือนจุดด่างดำ 57% ใน 4 สัปดาห์จริงหรือ L'Oréal Paris Glycolic Bright Serum
ผลลัพธ์เหลือเชื่อมากไม่คิดว่าจุดด่างดำบนใบหน้าจะจางลงได้ค่ะ
ประทับใจตั้งแต่ครั้งแรกที่ใช้เลยค่ะ
ทดสอบทางคลินิกแล้วช่วยลดเลือนจุดด่างดำได้ถึง 57%
โดยผู้เชี่ยวชาญด้านผิวหนังเลือกใช้
L'Oréal Paris Glycolic Bright Serum
At Bloomberg, we believe in the power of ideas. That's why we launched Bloomberg New Economy Catalyst. It's a community of global leaders and innovators who are blazing new trails to transform business and government. This platform will help them share their ideas with the world and provide access to the resources they need to bring them to life. Bold thinking, breakthrough action. Bloomberg New Economy Catalyst.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, China's factory activity contracted for a second straight month in August. That was as the economy took a hit from power shortages, a continuing property crisis, and COVID outbreaks. We're joined now by Enda Kern, our chief Asia economics correspondent in Hong Kong. So, Enda, digging through the data here, what are some of the main takeaways?
I think output and new orders, I should say, were definitely among the weak sides of this, Danny. The manufacturing side, it actually nudged up a little bit, but remains well into contractionary territory. That's because of the pressure on the industrial side of things from those power outages, of course, and from slowing global demand for goods out of China. So the manufacturing story is definitely still in something of a rut. But on the services side, we saw slowing growth on the services side too, and that's mostly down to tourism and consumers not spending as much. You have to look at Hainan, for example, the holiday resort island that came under lockdown, to explain what's going on there. So you take it all together, it all speaks to a lot more pressure on China's economy.
And how does this end? Does it end with government support? Does it end with, weather, droughts, all of that getting better? I mean, how far are we from a turning point?
Well, something has to pivot, Danny, no doubt about it. The feeling so far is the policy support going into the economy, about 1 trillion yuan worth in total, is not enough, or at least is not having traction. So there's going to need to be a pivot somewhere. Will it be the zero COVID? Will it be on the real estate sector or something else? We don't know yet, but we do have a date for the all-important Party Congress coming up now, starting October 16th. That won't lay out definitive plans for the economy, but it could certainly give a signal if there is going to be policy shift around them.
All right, Enda, thank you very much. Enda Kern, they're our chief Asia economics correspondent in Hong Kong. And yeah, Asia markets not too upset, it would seem, by some of these numbers. We did see gains, or basically flat in Chinese equities, and the renminbi gaining slightly against the dollar. All right, coming up, we're going to turn to the UK with Treasury estimates showing energy firms are set for billions of pounds in excess profits in the coming years. Could the windfall tax on power producers be extended as we look at price caps set to raise by 80% from October, with the squeeze on energy bills and consumers possibly paying triple for energy this winter? More on that next. This is Bloomberg.
SCG ล็อกสีสวยทนจากทุกสภาพแวดล้อมที่มีเทคโนโลยี Color Lock Plus
เซรั่มช่วยลดเลือนจุดด่างดำ 57% ใน 4 สัปดาห์จริงหรือ L'Oreal Paris Glycolic Bright Serum
ผลลัพธ์เหลือเชื่อมากไม่คิดว่า
โดยผู้เชี่ยวชาญด้านผิวหนังเลือกใช้
L'Oreal Paris Glycolic Bright Serum
We believe in the power of ideas. That's why we launched Bloomberg New Economy Catalyst. This platform will help them share their ideas to reshape our world. Bold thinking, breakthrough action. Bloomberg New Economy Catalyst.
To automate the process.
You want to write your resume for robots, not for humans. The only job your resume has
is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Turning off the taps, the Nord Stream pipeline begins a planned 3-day shutdown as Gazprom halts delivery to France's end. Back to work. Goldman Sachs and Morgan Stanley call in their employees dropping COVID rules as Wall Street looks to get back to the office. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now let's get to a Bloomberg exclusive. UK gas and electricity producers could be in line for £170 billion in excess profits over the next 2 years. Now that's according to the Treasury sum. It's something officials will be presenting to the incoming Prime Minister and shows the potential of expanding the windfall tax. Joining us now on this is Bloomberg's Lizzie Burden. So, Lizzie, if anything, this Bloomberg scoop, it highlights some of the internal wrangling within the government.
Liz Truss to continue the windfall tax. And of course, Truss has said that she's opposed to a windfall tax because she says that it puts off investors. And Kwasi Kwarteng, the man who's tipped to be her chancellor, has also said that he's opposed to it on principle. But of course, both Truss and Rishi Sunak, her leadership rival, have said that they would give more support for households through the cost of living crisis. It's not exactly clear how much. These estimates show that if the windfall tax were continued at 25%, it would generate tens of billions of pounds in revenue for the Treasury, which
essentially saying that if we see another hike of 80% in the cap come January, inflation in the UK could hit 22%. I know there was that City report from a while back, what was it, last week, the week before, saying potentially 18%. Where do we stand when it comes to inflation in the UK?
Well, to just put a bit of history into it, RPI was at, I think it was 26% in 1975 because of the oil shock. So it's reaching that level as if this Goldman forecasts anything to go by. It's based on energy bills rising to £3,500 in October. And then, of course, forecasters saying that they could go above £6,000 next year. But even if 22% is an aggressive figure, what it really shows is that the hopes of inflation peaking in October are starting to fade. Goldman has said that it would trigger a 3.4% drop in GDP. It says even if energy costs do moderate, it would still be a peak of 14%. So it really underscores the scale of the crisis that awaits the next Prime Minister and the pain the Bank of England's going to have to inflict to bring it under control.
Lizzie, thank you so much. That's Bloomberg's Lizzie Burden, which sets up our next guest guest perfectly. Joining us now is Charlie Bean, former Deputy Governor for Monetary Policy at the Bank of England and now professor at the London School of Economics. Charlie, I got to say, it's hard not to listen to Lizzie, the concern about inflation, energy bills tripling, and not get this pessimistic view of where we're heading when it comes to the UK economy. Are you pessimistic? What's your base case for where the country's economy goes from here on out?
Well, the country is certainly facing a professional career back in the 70s in the Treasury. And that was a pretty challenging time. And it wasn't just a single spike in inflation. It was persistently high inflation. While the immediate prospects for inflation obviously or 80. We don't know, and nobody should claim they know it's going to know. They know, but it is likely to stay pretty high. What worries me, and I think will be worrying the bank and the Monetary Policy Committee, is the extent to which that inflation then gets ingrained into the system with people asking for higher wages to compensate, which we're seeing. I think to some extent the answer is yes. People have focused on inflation expectations, but they have tended to forget this, what used to be called real wage resistance, people trying to preserve the purchasing power of their pay, and equally businesses pushing through the cost increases into their final prices. For that reason, and given that the labour market is still pretty tight, I think we will see more persistent inflation than perhaps people have factored in, and the consequence of that will be that monetary policy has to remain tighter for longer than one might hope. Now, I may be wrong in this. It is one of these areas where we don't know, but that is my fear.
Well, it does feel like one of the things that we're grappling with in this country right now is the idea of flying blind, especially as we're looking at an incoming prime minister, different proposals there. You have Liz Truss talking about tax cuts. You have everyone talking about immediate relief when it comes to the energy bill. Are we flying blind in terms of what the impact to those types of things will be on inflation, on the economy, and everyday consumers?
Well, I mean, some of the policies that people have talked about, we know what their impact is likely to be. Maybe not perfectly if you support rough idea how people will respond. The problem with the uncertainty at the moment is that we don't know what the policies are going to be, and won't until the conclusion of the leadership election. Now, I mean, all the polling seems to suggest that it's likely to be Liz Truss. What worries me about what she's proposed so far, which of course may be very different from what is implemented, the households that are suffering most, does relatively little for small businesses as well, and more particularly they're intended to be permanent.
And if I can jump in here, Charlie, I mean, this is coming at a time where we're getting rates that are moving higher. Can public finances handle higher rates and an increasing public debt burden if we are to see tax cuts?
I think just as in the pandemic, then I don't think there is likely to be particular difficulties in financing that by borrowing. What will be far more problematic is if you're running an ongoing deficit. And I think the tax reductions relative to what are presently programmed in run that risk. And certainly the 30 billion headroom that was in the last OBR4 and not going ahead with Rishi Sunak's planned increase in corporate taxes, that 30 billion won't be there now. With higher debt interest, there'll be higher welfare payments because of the higher inflation. Lower growth is also going to damage tax revenues.
What sort of
higher energy prices are going to damage the supply side. So I actually think the medium-term fiscal position will be even more challenging than it was.
Bailey and his colleagues in?
Well, the immediate difficulty facing the bank is their next decision will be taken without knowing probably what the government's fiscal actions are going to be. But the rhetoric, certainly at Jackson Hole last week, was much more hawkish from both Jay Powell and the ECB, and also from Andrew himself. So I think they will be torn in that they want to keep on sending the message they are going to make sure inflation is brought back to target, but also wanting to wait. Government does go ahead with fiscal actions which potentially open up a large sustained deficit in the medium term, so it's not a short-term action, but raises questions about the sustainability of the public finances, coupled with the suggestion that they may rewrite the mandate of the bank and so forth. I could see investors starting to think the UK doesn't look such a good place to invest. You'll see a risk premium. You could see a very difficult situation evolving for the government in the autumn or early next year, when it finds it much more expensive to finance its borrowing, and sterling is coming under pressure, which forces the bank to run a tighter monetary policy.
Yeah, I had a guest on the other day who was talking about parity or worse for sterling versus the dollar, so certainly a conversation being had now. Charlie, afraid we're out of time. Thank you so much for joining. It's great to have you on. Charlie Bean there, former Deputy Governor for Monetary Policy at the Bank of England and Professor at Don't miss that next. This is Bloomberg.
ไม้สังเคราะห์ SCG ล็อกสีสวยทนจากทุกสภาพแวดล้อมที่มีเทคโนโลยี Color Lock Plus
เซรั่มช่วยลดเลือนจุดด่างดำ 57% ใน 4 สัปดาห์จริงหรือ L'Oreal Paris Glycolic Bright Serum
ผลลัพธ์เหลือเชื่อมากไม่คิดว่าจุดด่างดำบนใบหน้าจะจางลงได้ค่ะ
ประทับใจตั้งแต่ครั้งแรกที่ใช้เลยค่ะ
ทดสอบทางคลินิกแล้วช่วยลดเลือนจุดด่างดำได้ถึง 57%
โดยผู้เชี่ยวชาญด้านผิวหนังเลือกใช้
L'Oreal Paris Glycolic Bright Serum
Bold thinking, breakthrough action, Bloomberg New Economy Catalyst.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our targets.
Spare capacity is becoming scarce. We are running on thin ice.
No one deliberately wants to go into battle, but we sleepwalk into conflict.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. With volatility and crises plaguing many financial markets, companies and investors are increasingly looking to alternative investments. Now, after a record in 2021, private equity interactions have declined about 30% this year, but they're at over $970 billion. And that volume, well, it's still high compared to historical averages. We're joined now by Simona Mailare, co-head of Alternative Capital Group at UBS. Simona, thanks so much for joining us. I mean, look, 2021, it was kind of a weird year, and just, private equity had so much making up to do for the pandemic. When we look at the slowing volume this year, to what degree does it slow to what looks like crisis levels, or do you expect it to be maintained despite everything that's unfolding in Europe?
We have seen actually an extraordinary resilience in the first part of the year, which has been somewhat counterintuitive given the geopolitical and the macroeconomic backdrop. So as you just said, the volume of deals went up compared to last year still. And the reason is because there is still a lot of money to be spent. There is $1 trillion of dry powder that needs to find an avenue to be spent. And also a lot of the deals that happened were deals that were cooked in 2021. And then we saw syndicated loan markets, we saw the high yield market in distress, but private credit came to the rescue and provided fuel for a lot of deals.
Yeah, and of course what we see when there's not a lot of deals available, there's a lot of dry powder. Firms end up paying up more because they need to get the deals. Supply is just low. But as we look at valuations crack in public markets, do you expect that same cracking, or have we seen it in the private arena?
We will see it. I think valuations are already going down. When you look at the deals in Europe that have been done in the first 6 months of the year, the median valuation has been around 11.5 versus the 14 times we've seen last year. So these are levels from 2016. Now, it's normal that valuations are going down. There is a mathematical effect of interest rate going up, discount rate going up, valuation going down, but it's also portfolio companies are suffering. They're suffering because of margin pressure, supply chain disruption, labor cost, and you name all the issues I'm sure you've been discussing. So I expect valuation to go down. We're not there yet, meaning we need to find a new equilibrium. It's a bit like, I always say, like the real estate price in London. They never really go down, but there is a time where still seller have high expectation and buyer wants to buy at lower price. We need to find a new equilibrium. Will we find it this year? I'm not sure, but
I got to say, and I've heard a lot of criticisms, and these come from mostly public equity investors, I will admit, but basically saying that, look, it's just this mirage of low volatility because private equity isn't marked to market. Is there any truth in that they should be behaving with, bear market in public equities, that the private world should be that bad? It's just this, illusion. Again, not my words. It's some of these portfolio managers saying this.
Listen, the mark to market provides an element of discretionality of how down you want to market your asset, but at the end of the day, LPs are becoming much more savvy and they scrutinize this valuation with a bigger lens. Now, keep in mind that there is a major difference between private and public market valuation. This PE owns assets for 3 to 5 years, so they can afford a blip. So they can afford the cyclical downturns because the exit is going to come later. And this is very different from public market where you tend to go in and out much quicker. So I think part of it is justified by this.
Yeah. Is there any point when we're looking at a world where Fed, ECB, pretty much everyone, perhaps save for Japan and China, is looking at raising rates, where the strategy of being funded by cheap money, doing deals with major leverage, saddling up companies with debt, that sort of model of private financing ceases to work, or at least ceases to work in the manner that it has over the past decade?
I would argue that this model has ceased to work already because of competition. Now, remember, private private equity was an industry where it was all about financial engineering when it was born. You buy an asset, you put leverage, you increase a bit your EBITDA, you sell, you make money. But competition meant that in the last 5 to 10 years, all the PE had to develop operational expertise, had to focus on add-on acquisitions and doing more. So I think they're better equipped today than they were when the global financial crisis happened to deal with it. But I agree with you. When you look at the last 5 years, most of the value creation has been multiple expansion. I mean, some study prove it's more than 50%. This is not going to happen for the old vintage. For this new vintage, I think there will be fantastic opportunities once the valuation will realign.
Simona, we're going to have to end it there, but I love it, ending with a little bit of optimism. It's something we definitely all need right now. That's Simona Mailare, co-head of UBS Alternative Capital Group. Now let's get to your Bloomberg Business Flash. With that is Leanne Gerrans. Good morning, Leanne.
Gazprom says it will halt gas supplies to French utility ENGIE because of a disagreement over payments. The Russian company accuses ENGIE of not paying in full for July deliveries. Meanwhile, European Commission President Ursula von der Leyen says the EU has met its winter gas storage goal 2 months ahead of target, with reserves now at an average level of 80%. China's factory activity has contracted for a second straight month. The official manufacturing PMI was higher in August, but at 49.4. Spurred by a historic drought, a continuing property market crisis, and also COVID restrictions. And Snap is said to be planning to lay off around 20% of its 6,500 staff. According to the tech website The Verge, the social media company which owns Snapchat is going to start the layoffs today. The report says the team working on minis, small applications made by third parties, will be among the most affected. And that's your Bloomberg Business Flash. Danny.
Leanne, thanks so much. Coming up, 2 Wall Street banks ditched some of their last remaining COVID protocols, laying the way for return to office. That's next.
ไม้สังเคราะห์ SCG ล็อกสีสวยทนจากทุกสภาพแวดล้อมที่มีเทคโนโลยี Color Lock Plus
เซรั่มช่วยลดเลือนจุดด่างดำ 57% ใน 4 สัปดาห์จริงหรือ L'Oreal Paris Glycolic Bright Serum
ผลลัพธ์เหลือเชื่อมากไม่คิดว่าจุดด่างดำบนใบหน้าจะจางลงได้ค่ะ
ประทับใจตั้งแต่ครั้งแรกที่ใช้เลยค่ะ
ทดสอบทางคลินิกแล้วช่วยลดเลือนจุดด่างดำได้ถึง 57%
โดยผู้เชี่ยวชาญด้านผิวหนังเลือกใช้
L'Oreal Paris Glycolic Bright Serum
We believe in the power of ideas. Bold thinking, breakthrough action, Bloomberg New Economy Catalyst.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China. But African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
A Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Goldman Sachs is lifting some of its final COVID rules, including vaccination requirements. The New York Post says it's seen a memo ordering staff back to the office 5 days a week. It follows a similar move by Morgan Stanley. For more on this, we're joined by Bloomberg's William Shaw in London. So, Will, what changes exactly are Goldman and Morgan Stanley making to their return to office policies?
Well, it looks like the Wall Street pandemic era working culture may be coming to an end. Goldman Sachs has told its staff outside of New York that they can re-enter the offices regardless of whether or not they're vaccinated. In New York, they've said that staff with a medical or religious exemption to the vaccination mandate will be able to enter without testing or face masks. Morgan Stanley have got something similar. They've told their New York staff that it will end its test and control measures, including exposure notification emails. So those processes that were in place are starting to be wound down effectively.
So when it comes to Goldman, I mean, are we essentially back to the pre-pandemic era type of arrangements? Where does the firm stand?
Breakfasts and free lunches at the office, a perk that some firms have been using to try and persuade people to come back in during the pandemic era.
Ain't no such thing as a free lunch. Will, this might be a little bit cynical, but especially in this day and age, I think it's relevant in terms of, workers' calculus of whether to go into the office, whether to stay at home at a time when energy bills are soaring. What does that look? Does that push people to get back into the office when they're looking at a winter where heating is particularly expensive?
I mean, I think that's very relevant, isn't it? I mean, workers will be thinking, like, on the one hand, gasoline prices are very high at the moment, and the cost of living means that public transport is expensive. They'll be asking themselves, is it worth spending that money to go into the office? At the same time, to think about it from quite a grim perspective, as it starts to get colder, people might start to think, well, am I better off going into the office in order to get the free heating? On the other hand, like banks will be conscious that the employment market is not what it was like pre-pandemic, and there are a lot of fintech companies out there that are offering high salaries and the opportunity to work at home 5 days a week if people are prepared to jump ship from big established banks. So it's quite a nuanced calculation. I wouldn't necessarily gamble on workers flocking back as an overwhelming majority based on these measures that banks like Morgan Stanley and Goldman Sachs are taking.
Yeah, I mean, totally fair. Well, all of this in the context of an As we close out the hour, we are looking at equities unable to hold on to gains. The future session for Europe started out strong. Still some resilience in the U.S., but that has been fading as we get closer to the open. Nat gas prices continue to spike. We'll continue the conversation on Bloomberg Surveillance Early Edition in the next hour. This is Bloomberg.
Color Lock Plus.
We believe in the power of ideas. That's why we launched Bloomberg New Economy Catalyst. This platform will help them share their ideas to reshape our world. Bold thinking, breakthrough action. Bloomberg New Economy Catalyst.
I went back and looked, and very few secretaries of state in the last 100 years, or maybe ever, have really gone back into government. So why did you want to come back into government for any issue when you've got 8 grandchildren, you've got 2 daughters, you've got wonderful family? Why did you want to come back and go through this terrible process we have in Washington of getting things through consensus and getting people to agree to what you want to do?
Because I want those grandchildren to have a future. It's very simple. We're not in a good track right now. The world is not serious enough about reducing our emissions fast enough, David. And the result is that the planet is going to continue to evolve in reaction to what we human beings are doing to it, mostly through fossil fuels. Energy that comes from the ocean, goes into the storms, the floods, the rain, all of it is explainable, and it's all linked to the changes we are creating on the planet. So it's very simple. I wanted to come in because I think we have a real chance now to make something happen, and I think Glasgow was a major step forward in the effort to do that.
The difference between political gossip and policy intelligence. Bloomberg Government provides our clients with expert reporting, analysis, and public affairs tools that give you the edge in reaching policymakers for knowledge you can act upon. The difference is Bloomberg Government.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I'm paying attention to what the Fed is telling us.
I think you are fighting the Fed if you're bullish. It's hard to find anybody that's bullish now.
I think the Fed will be able to control a massive downward ascent.
The next 3 to 4 months through the rest of this year, it's going to be a really volatile time.
You have to be opportunistic. You have to be patient.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 the office. Goldman Sachs and Morgan Stanley clear the way by lifting some of their final COVID restrictions. Job cuts are reportedly on the way at the parent of Snapchat. Snap is said to be laying off almost 20% of its nearly 6,500 employees. And more revelations about classified documents found at Donald Trump's Florida home. The Justice Department and Kriti Gupta in New York. Kelly Lines is off today. And Kriti, in terms of the market response here in Europe, it seems a gas gloom once again descends, but US futures point a little higher.
Just a little bit higher. But what's interesting is in Asia, that wasn't exactly the sentiment that we've really ended the Asian session with. In fact, we actually ended, if you look at the MSCI Pacific Index, higher by 0.2%. But Anna, I wouldn't call it by conviction by any measure. In fact, if you look at the Nikkei, which I think is really where a lot of the sentiment crosses into when you look at Europe and then ultimately the Asian session as well, it was actually ending the session down about 0.4%. Remember, those stocks are largely going to be tech-based as well. So if we're looking for some sort of indication on where exactly some of the tech stocks, for example, that, by the way, you need on the S&P 500 side to really make your bull case, where they're heading in today's trading session, well, based on Japanese trading, you aren't actually going to see that much help on the equity side. But I really want to look at the currency market. As Matt Miller pointed out, comes to their currency base. And I really like to look at the Indian rupee. We don't do that often on this show. We talk about the yen, for example, or the Chinese yuan, but the Indian rupee circling that key 80 level, and that's going to be significant as we talk about just how much weaker it can get and just how much the Reserve Bank of India can actually do to stem that weakness. And on the other hand, the Chinese yuan, well, it is coming out stronger. The PBOC actually fixing it higher than expected for many, I want to say the 5th or 6th straight session that we are seeing for a while here.
I think we should start looking at the rupee more, as we now have Gautam Adani in the top 3 richest men in the world. We'll talk about that a little bit later. Take a look at S&P futures right now. They are drop again of about 1%. So now markets are trying to decide which way to go. In terms of the 10-year yield, it's up right now as investors let go of those bonds, but only by almost 3 basis points. 31.3 as a pretty high level, 3.13, 3.12. And you see the Bloomberg Dollar Index coming back up a little bit. It had dipped down, but now at 12.97, we're back in the 1,300 territory. So we're getting back closer to those all-time highs that we last saw in July. And then Bitcoin right now rallying up about 1%, and it's holding just over $20,000 at 20,200 and change. And so maybe that is a positive, a positive sign for the U.S. Open in 4.5 hours from now. What do you see in Europe?
Yeah, just as you were talking there, Matt, the S&P futures picture then just dropping into negative territory, only marginally, but clearly undecided, as you say, about where to head. And we have a pretty undecided picture here in Europe. It's negative, but we had gains earlier on, so we've given up those earlier gains and fallen into the negative path. So the FTSE 100 down by 0.9%, the CAC 40 down by 0.8%. We're all about inflation once again, and inflation watch. Euro area August consumer prices rising 9.1%. That data just hitting the Bloomberg terminal. 9.1% is a little bit higher than the estimate of 9%. And so that paints an interesting picture about inflation story here in Europe that's coming in above estimates. So economists still lowballing those estimates about where inflation is, and that the actual numbers are beating. And these numbers are actually coming in higher than prior readings of inflation as well. So no sense that we've peaked on that inflation picture overall in the Eurozone. What impact is that having on the euro? And this is interesting because we were just above the 1 level on euro dollar before that data hit, and the market has taken this as a negative. So the market is not thinking, well, that means more hawkish ECB, let's buy the euro as a result. The market is thinking this is bad for the Eurozone economy and selling the euro, it seems to me on first glance. Natural gas prices are also an area of concern for Europe today. This is day 1 of a 3-day shutdown of Nord Stream 1. It was planned, it was pre-announced by the Kremlin. They say it's for maintenance. European leaders doubt that. But the big question is whether the gas gets turned back on. And we've had a lot of conversations about storage and how Europe weathers, of course, the winter. So natural gas prices jumping a bit this morning. Brent crude down another 2%. We had a $7 range on oil prices broadly yesterday. Quite a big range of movement and a big move downwards on news flow coming through from Iraq. But we're cautioned by some of our colleagues not to read too much into that big move lower yesterday because it is the end of August. But Brent crude now substantially below 100 at 96.94. And I put in Drax Group. Big profits, Chrissy.
Yeah, and at its heart, it really becomes and remains a commodity story. Let's see how long that really lasts as well, which brings me to what we're looking at ahead today. As Anna mentioned, and worth bear repeating, Russia's Gazprom stops delivering natural gas to Europe through its main pipeline, Nord Stream 1, for 3 days of maintenance. The shutdown will likely further squeeze energy supplies. And the ADP's National Employment Report, a staple of U.S. labor data ahead of the government's payrolls release, will end its with remarks from Cleveland Fed President Loretta Mester, Dallas Fed President Lori Logan, and Atlanta Fed President Raphael Bostic. Matt?
All right, let's get to some bank news. And by the way, I note just now coming across the Bloomberg terminal headlines that J.P. Morgan's Frankfurt offices were raided as part of the CumEx tax probe that has been ongoing for years. But just to point out, there's that raid to keep in mind in Frankfurt. Back here in the U.S., 2 of Wall Street's best-known investment banks say it's time to come back to work. Goldman Sachs and Morgan Stanley are removing some of their last COVID restrictions after the Labor Day weekend. Shonali Bassig, our global finance correspondent, joins us now. So, Shonali, is Goldman Sachs an outlier when it comes to these banks, Morgan Stanley, I guess, now joining the team.
Yeah, when you look at what Goldman's communications to employees was, it was about COVID. It was not necessarily about return to work. However, the tone from the managers has certainly been that beyond what we've seen in the most recent communications. They were one of the first firms to bring people back to work. But when it comes to coming back to work, if you look for what the Partnership for New York City has said, about 40%, less than 40% of employees in New York area have been coming back to work. CDC guidelines, the idea of significantly less severe risk of illness, and also these rules do vary across the banks. For Morgan Stanley, the isolation rules after being exposed are different than they are at Goldman slightly in terms of how they've communicated to staff. I would also say the vaccine requirements have changed for these banks, and Goldman cites New York's vaccine mandate, so really they're following the regional rules here as well. So there's two things going on here at the same time, both this idea around COVID and restrictions easing, and the idea that Labor Day
from the bank side, how much anxiety is there really from the banker side as they're being asked to come back in?
Listen, a lot of Wall Street business lines are down significantly, and so that means that there is a lot of pressure for employees to be back at the last part of the year. And the businesses that are performing well, like trading businesses, Kriti, and even in some ways M&A businesses, there is an expectation that market share gains are equally as important at this point in time. Remember, there have already been significant pressures on compensation expenses. In the first half of the year alone, you have Goldman cutting compensation expenses by $3.5 billion compared to last year in the first half of the year. So the banks have already said that they are keeping a clamp on expenses. 5% of a workforce, and not just at Goldman Sachs. But the question is, if the environment becomes worse, does that 5% become 10% or even greater at some of these banks?
All right, Shonali, thanks very much. Shonali Basak there, our Wall Street reporter covering the banks for us this morning. Now, shares of Snap on the other coast are falling this morning, according to Verge. The parent of Snapchat plans to lay off about 20% of its nearly 6,500 employees starting today. Joining us now for more is Alex Webb of Bloomberg Quick Take. So, Alex, first of all, Snap specifically, before we get to the broader industry and the broader labor market, why are they doing this?
Snap's had a particularly torrid year. It missed the market's estimates for its earnings in the most recent quarter. So The Verge is reporting it. It was clear that they were going to have to do something. They would have to perhaps cut some jobs. So Verge is now reporting they're going to cut, as you say, 20% of their workforce. That equates to somewhere between 12 and 1,300 employees. They've been piling quite hard into hardware. You know, they made a drone which can take photos. They cut that product. It seems as though those are the things that are being tamped back on. You know, the shares are down 90% from their 2021 peak. Company's now valued at about $16 billion. So it was clear that some action was needed.
And Alex, we've heard talk of job cuts in other
is that it is a lot smaller, particularly than Facebook. Facebook has something in the order of 2 billion daily active users. Snap has just 300 million. Facebook has $120 billion annual revenue. Snap has just 5 billion annual revenue. So it's got far less wiggle room than some of those other big companies. And if you look at where the competition is coming right now, particularly TikTok, it is targeting very much the demographic that Snap has been targeting itself. Those young users, 18 to 25-year-olds, sometimes just teenagers. Now, these moves could save something in the order of $250 million. But Snap, for all its 5 years as a public company, has never been profitable on a net or operating basis. So it is therefore got far less wiggle room.
We had JOLTS data showing that job openings rose back to almost a record 11.8 million. So we still see job cuts, though, in tech. Now, the Justice Department says White House records held in a storage room at Donald Trump's Florida home may have been moved before an FBI search in June. Officials say that could have been an attempt to obstruct the investigation. Jack Fitzpatrick, Bloomberg government reporter, joins us now from D.C. with more. Jack?
Yeah, so the issue here is that there was a significant back and forth between former President Donald Trump and his lawyers and the National Archives and the FBI well before the August 8th search of Mar-a-Lago that is in question that they had the search warrant for. A big back and forth was in June in which the FBI visited Mar-a-Lago, and Trump's lawyers had said they were responsive to all the relevant requests for top secret and SCI clearance level documents. And then, of course, on that August 8th search, the FBI said they found about twice as many documents that Trump's lawyers had said were already turned over if they were relevant to that search. So obviously, it gives you a sense of the scope that they found quite a bit, which the FBI had already said, but also the fact that there seems to have been some attempt to either hide them or at least some dishonesty with the FBI about the former president's lawyers' willingness to cooperate.
And Jack, on to the current administration. President Biden has criticized Republicans for let's listen.
It's sickening to see the new attacks on the FBI, threatening the life of law enforcement agents and their families for simply carrying out the law and doing their job.
Looking ahead, Biden plans to deliver a primetime address tomorrow in Philadelphia. What do we now expect, Jack?
Well, you could see basically the focus that the president is taking on the campaign. The White House has described it, but even the policing issues, that speech yesterday that was supposed to be about support for police sort of intertwined the issue of local police funding with the FBI. You know, the key line, I think, was when President Biden said, I'm opposed to defunding the police, I'm also opposed to defunding the FBI, really hammering Republicans for not standing by the FBI during or after this. So it's you know, a lot of the time midterms focus on the state of the economy under the president. In this case, the president is pretty aggressive going out on the campaign trail, supporting John Fetterman, supporting Matt Cartwright in a competitive race, and making policing a significant issue. And I think we'll hear more of that in Philadelphia tomorrow.
Certainly something we're going to be looking forward to. Jack Fitzpatrick of Bloomberg Government, we thank you as always. Now let's take a look at some of the stocks moving in pre-market trading in the United States. Snapchat is something we've of course already discussed with Alex Webb, but it's worth looking at once again because it is actively moving the shares. You do actually see shares down to tune about 7% in light of those job cuts, and this is significant as we start to see a lot of these tech names, and I want to say big tech as well, although Snapchat perhaps doesn't qualify under that name, starting to make those massive cuts, and it really has to do with the story of preparing for recession. And with that story comes HP as well. Actually was starting to reduce their profit forecast as those PC sales continue to slide. The idea here simply being that in a recession, it's not just about the consumer, it's about business investment as well. And right now, HP shares are under pressure to the tune of about 6.8%. Once again, if you don't have that business investment on your side, they're cutting back, they're preparing for a downturn. What does that say for the rest of the economy? Strategic update. Those shares are up about 1.6%, but once again, this is not in line with the over 10% move we saw in yesterday's session. Will it actually sustain, given perhaps some risk-off indicators in the broader market, Anna?
Chrissy, coming up on the programme, we'll talk to Mark Haefele, UBS Global Wealth Management Chief Investment Officer. We'll get his perspective on the Eurozone economy for sure, but also on global investment approaches, the logic of fighting the Fed or not. And credit markets may be underpricing the risk of recession. We will deep dive into the credit markets. A lot to look ahead to in September, of course, in that market. Plus, Shell's botched $1 billion oil cleanup. How mismanagement, waste and lack of transparency are making a pollution hotspot even worse. Read more in today's Big Take story. You can look at that online or by typing NI Big Take into your Bloomberg terminal. This is Bloomberg.
Get the power of app analytics and engagement in one single platform.
At Bloomberg, we believe in the power of ideas. That's why we launched Bloomberg New Economy Catalyst. It's a community of global leaders and innovators. World and provide access to the resources they need to bring them to life. Bold thinking, breakthrough action. Bloomberg New Economy Catalyst.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Last month's jobs report caught everyone off guard.
This is quite a surprise. Oh my, as Dick Enberg would say.
That is a wow statistic.
That recession talk just got a freezing cold shower.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
It's good news, bad news, good news.
They're walking that fine line.
We still have a large gap between jobs and workers, but at least we're moving in the right direction.
The market has 2023 wrong.
The August jobs report, Friday on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kriti Gupta here in New York, Anna Edwards out in London. And for those of you listening on radio, I've got a chart here that I'm showing our TV viewers. You should really check out when you get to your offices and log in. The terminal number is #BTV 2493. I just think it's an amazing chart, and it's connected to so much volatility in the commodities markets and leaving many Europeans and some Brits breathless. We're Ukraine transit. It's pretty dramatic. Joining us, Ksenia Galuchko, Bloomberg Equities editor out of London, to talk about how this has affected markets through inflation and really driving up cost of living and making things more difficult for Europeans.
Absolutely, Matt. I mean, this will be in focus for the rest of the year, if not the next 12 months. The fact that Russia is reducing gas supplies to Europe is not bidding well for this upcoming winter. And while major countries like France, like Germany, are now preparing for a drop in gas supplies, at the same time, this is surely going to drive up energy prices, and this is only going to bump up inflation and also weigh on consumers who are already facing consumer crisis.
Yeah, and Ksenia, we've already seen no less up in the inflation story across the Eurozone with that data out just this morning. Let me ask you about the broader, let's go to the US economy and how data is being received by markets, the market mentality, I suppose, because it's interesting that JP Morgan has a note out saying that they see, strategists there see a bullish stock signal in US jobs data. I assume they're not talking about the JOLTS numbers of yesterday because they were not taken well by risk assets.
Absolutely, yes. So they're actually talking the Federal Reserve will remain hawkish and earnings are said to drop from here. So they are much more cautious, and they say that the sell-off in equities that we saw in the first half of the year will continue, pairing the rally that we saw during the summer. So JP Morgan is very much an optimist and almost a sole optimist among major Wall Street strategies in that sense. So we'll just have to see what the Federal Reserve does in September and also how earnings react in the next 12 months.
Yeah, it'll be really interesting to watch the link then between this jobs data and the way the risk assets perform. Ksenia, thank you very much for joining us. Ksenia Galushko joining us there with market analysis. And for more, you can check out the Markets Live blog. MLIV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
Color Lock Plus. You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close, weekdays on Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Strong enough to stay, we will never.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
Now keeping you up to date with the news from around the world. X scandal that cost taxpayers billions of euros. JP Morgan says it continues to cooperate with the authorities. CumEx was a trading strategy that siphoned off at least $10 billion in tax revenue. And Mikhail Gorbachev is being remembered as the last leader of the Soviet Union who ended the Cold War.
At Bloomberg, we believe in the power of ideas. That's why we launched Bloomberg New Economy Catalyst. It's a community of global leaders and innovators who are blazing new trails to transform business and government. This platform will help them share their ideas with the world and provide access to the resources they need to bring them to life. Bold thinking, breakthrough action, Bloomberg New Economy Catalyst.
Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we're seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
The top names at the Fed are on Bloomberg.
It is essential we get inflation down. People want jobs, but they also want low and stable inflation. We have to give them both.
Nobody covers the Fed like Bloomberg, your global business authority.
What is your base case for Italy in terms of what happens politically and then what the economic fallout is?
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Two of Wall Street's best-known banks tell employees it's time to return to the office. Goldman Sachs and Morgan Stanley clear the way by lifting some of their final COVID restrictions. Job cuts are reportedly on the way at the parent of Snapchat. Snap is said to be laying off almost 20% of its nearly 6,500 employees. And more revelations about classified documents found at Donald Trump's Florida home. The Justice Department suggests there may have been attempts to obstruct the investigation. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kriti Gupta in New York. Kaylee Lyons is off today. And Matt, European equity markets giving up on early gains. US futures, last time we checked them, pretty undecided. How do they look now?
Yeah, they were very unchanged, and frankly, they haven't moved that much, although they are to the downside, so in the red, just about 0.1% on S&P futures. But recall, we've had losses over the last 3 trading sessions. It'll be interesting to see if we stick to these losses. Of course, we still have about 4 hours until the U.S. Open. The 10-year yield starting to rise right now as investors sell off that debt. Also a fairly small move, but to a significant level, 3.13 on the 10-year, nowhere close to where we see the 2-year, of course. That's about still 40 basis points away, but it is moving higher. The Bloomberg U.S. Dollar Index, really interesting because it had come back up almost to an all-time high last week, and now you can see it's coming back there again, 1297. So 1300 was the level we were flirting with, I think, on Monday, and we had come off that significantly. Maybe that's safe haven, maybe that's confidence in the U.S. economy relative to other economies. And then Bitcoin right now, also not moving very much, but holding just above $20,000, so that's significant, I guess. To some people, it's a big round number, 20,190. I feel like people are paying less attention. Is that wrong of me to say, Kriti, that people are paying a little bit less attention to Bitcoin?
I mean, it feels wrong coming out of your mouth, but
yeah.
it is, I think, a little bit true. If you look at it from a volatility-adjusted basis, it's only moving, 1-2% on a daily basis. You look at that historically, it's usually a 4% move. So maybe, Matt, but I would argue that the biggest theme this week is going to be payrolls that you're going to see on Friday, perhaps stocks in a little bit of a wait-and-see approach. That story gets even more interesting in light of the news we got out of Snapchat. Those job cuts are coming fast and furious. They were in big tech. Now they're going to perhaps the more tech-adjacent sectors. Snapchat really the poster child for that this morning. Shares are down 7% reacting to that story. But really, at the end of it, it becomes a question of business investment. That's where HP is concerned. They're actually revising their forecast lower when it comes to PC sales, and that is not, of course, going to be good for their bottom line. So those shares reeling a little bit, Anna, down about 7% this morning. But there is some good news in the market, some pockets of green here and there, and Bed Bath & Beyond is going to be a key metric for that, up about 2%. And of course, remember, they are waiting for that strategic update to come out, and on top of that, you have the retail base really vying for them. So let's see if that is a sustainable move this morning, Anna.
Yet another day at the Bed Bath & Beyond story, it seems. Kriti, this is what the European picture looks like right now. We've got European stocks down by 0.9%, giving up on those early gains, as I mentioned earlier on. Interesting to see the inflation data out for the Eurozone a little bit earlier on, and it was a little bit above estimates, which is not what the market wants to see, really. The market asking questions about when inflation peaks, and it seems we may have not got there, or at least we haven't already seen a peak in Eurozone inflation, we could say. So we continue to digest that latest inflation data out of Europe, and it's interesting to see the way the market has taken that. The euro had rallied quite strongly in the last couple of days on hawkish commentary from various ECB officials at Jackson Hole and then back here in Europe as well. But the market giving up on some of those recent gains in the euro in the wake of that data this morning, perhaps thinking that actually the fight against inflation is going to weigh on growth. We've got natural gas prices also moving this morning, up by 2.2%, and this is also something that could weigh on growth, of course. Ongoing focus on energy. We've got day one of a 3-day shutdown of the Nord Stream 1 pipeline. This was well flagged by the Kremlin, so this is happening as expected. They say it's for maintenance. European leaders doubt that, and the question is whether that gets turned on afterwards, of course. Brent crude really in focus this week. We saw a substantial drop in oil prices yesterday, and today we're at 96.10 on the Brent price, down another 3%. We're cautioned by some of our colleagues, though, to think carefully about what that means. Well, given that we're at the end of August, perhaps the volume's not too meaningful. Let us talk about where we are on markets, and in particular I want to focus on the European story. Mark Haefele, UBS Global Wealth Management Chief Investment Officer, joins us now. Mark, very nice to have you with us. Let me start with thoughts on the Eurozone and the fight against inflation, given that another high print on inflation, 9.1% for the Eurozone. What does this mean for the ECB in your calculations?
Well, I think you